Welcome back to the Value Investor Show, and oh my days, what a day. Today, just a few hours ago, UNH reported its most anticipated earnings in probably the last 5 years. I want to talk to you about what happened, why it happened, what the leadership said, and whether I'm buying or selling. So for today, we'll work through the results, the comments from the CEO, CFO in the earnings call, the headwinds ahead, my base, bear, and bull case scenario, the intrinsic value, and finally my final thoughts. So United Health Group just reported today 111.6 billion in revenue, beating estimates and showcasing 13% year over year. However, they have reported $4.08 in adjusted EPS versus an estimated 4.45 EPS, which is also down 40% year over year and has caused the shares to drop as much as 6% pre-market. At the time of recording, the shares are currently trading down 5%. Their full year outlook and 2025 revenue guidance, which has been set at 445 and 448 billion, implying 11 to 12% year-on-year growth. On the other hand, EPS guidance was lowered to at least $14.65 or $16 per share adjusted, and the CEO mentioned that they are on a rigorous path back to being a high-performing company, fully serving the health needs of individuals, and he also said that they are strengthening their operating discipline, positioning them for growth in 2026 and beyond as they look to provide long-term value to investors. Now, as you guys remember, United Health suspended its 2025 outlook back in May, and before that, EPS guidance stood at roughly $26.25 per share. You're seeing a drastic decrease in EPS, reflecting that expectations of higher realized care trends and pressure on margins are now in fact being reflected in the expectations. As the CEO said that they do expect to return to growth in 2026, I'll walk you through what happens next. But before we do, I want to go through the income statement. Looking at the income statements, revenue were up 13% year on year, which is very impressive. They saw increases across premiums, products, and services, which is all their three core businesses. However, with that being said, medical costs have increased significantly more, which has essentially eroded earnings from operations compared to last year. And also, I wanted to show you in the supplemental financial information that we see that for Q2, the operating margin for United Healthcare and for Optum has decreased. In fact, for United Healthcare, it has decreased from 5.4% to 2.4% over the last year. And then Optum Health also has decreased in terms of net margin. So overall, the company is facing serious margin pressure across all its segments, and as a result, it is driving a much lower EPS than we originally anticipated. I wanted to also flag this up because I think it's very important to understand why UNH is far better placed than their competitors. And the first thing that I wanted to flag is that their medical care ratio has increased 430 basis points year over year to 89.4%. And although this might seem very high, if we compare this to CNC that has reported last week, CNC has reported a medical cost ratio of 93% this quarter. So UNH is far below peers in terms of their medical care ratio, which shows that not only they are more diversified and performing better, but they're better operationally positioned than peers. And I do believe that UNH does have a core competitive edge and has greater resilience in tough conditions than other healthcare insurance companies. Now, the other thing I wanted to flag is the dividend rate. UNH has also increased their dividend rate by 5% to $2.21 and have returned 4.5 billion in buybacks. And so UNH is still deploying capital to return to their shareholders in any value they can. Now, my overall thoughts on these results, excluding the Q&A session, which I'm going to touch base on in a few seconds. My thought is that, is this the lowest we can get to? The previous guidance was 26.25 earnings per share, which has now significantly reduced to $16 per share. I do think that most of this has already been priced in, and in the earnings call specifically, one analyst asked if they still expect EPS growth as they originally highlighted, which was 13 to 16% growth, and the answer was that they expect low EPS double-digit growth beyond 2026, and they do expect this to grow steadily. But in the near term, I think that MA medical costs remain elevated. V28, as we suspected, as we knew, is still a very significant margin hit. Industry headwinds in HIX and Medicaid are increasingly affecting profits, and with the DOJ investigation still going on, there's a lot of downward pressure. So for me, the question is this the absolute bottom? Is it only a way up from here? Can UNH execute on what they have said? And if so, will that finally drive back EPS growth to what we have seen in the past? So in a nutshell, what happened in the earnings call is that firstly, it was a very long call. As you guys remember, a few days ago, UNH extended this call by 45 minutes. So it was essentially 45 minutes of leadership going through the results and the problems they're facing, and then another 45 minutes of Q&A. I think that leadership was extremely honest on the issues, very transparent, and also very optimistic on the long-term future of the business. And when I say long-term, I mean the next decade. They do expect headwinds to continue through to 2026, but they have said that over the last 60 days, they have already made changes to leadership, operations, and practices, and more are coming up. And with that being said, the key headwinds highlighted by the leadership in the earnings call is that firstly, there is rising healthcare utilization and costlier encounters. Secondly, Medicare Advantage V28 disruption. For example, Optum Health saw a 38% year-on-year decline in operating income due to the misaligned timing and underestimation of FX. On the other hand, ACA segment weakness. There has been a loss in the exchange business, notably a 1.2 billion hit, including the 620 million from individual plans due to membership decline and underpricing. And they're also having Medicaid challenges because of the behavioral health and pharmacy trends, which require renegotiated rates to keep margins intact. Now, with that being said, they do have a strategic response. They have a strategic shift. They have acknowledged the past mistakes. They chased top line growth too aggressively, which increased risks and compressed margins. And now they're shifting focus to margin improvement, to capital efficiency, and to boosting long-term value. So they highlighted a few things, a few steps are taken into consideration in order to improve the business. The first one is operational discipline. They're launching a payment integrity tools, coding reviews, and waste control to curb unnecessary costs. In fact, they said they expect 1 billion in cost savings in 2026 via AI, automation, and improved workflows. Secondly, in terms of their premium reset for 2026, they are expecting 50% of premium revenues repriced on January 1st, boosting pricing power and margin expansion in 2026-2027. Another key important point is that they're divesting away from some markets to focus on margins. For example, they're divesting their 1 billion Latin America operations to focus on their high growth, higher margins operations. And in fact, on Optum growth outlook, they were very optimistic about the high margin segments like Optum RX and Optum Insights. They do see a higher growth, a higher recovery, and higher margins in the future. They're investing much more heavier in implementing AI into those services and improving the technology, and they do think that this gives them a competitive edge, which fundamentally I also agree. Now, in terms of the outlook for the future, as I said, this strategic reset is necessary and constructive. They're focusing much more on disciplined growth and returns. UNH is setting up for stronger long-term performance, and near-term volatility I think will likely persist, but medium to long-term margins and returns will eventually look better. I don't think think we'll see any positive movement in the stock price in the next 6 months, but I do think that over the next 2 years, 3 years and more, we'll see a UNH that rebounds and gets back to a better level. Now, I think that is a perfect getaway to the valuation, to my model, and I have adjusted the assumptions based on the 2025 guidance. So just as a note, I have included in my analysis 2025 based on what they have said that they expect to get, and I have included growth estimates from 2026 onwards. So far, for my base case, I have included low double-digit growth as they highlighted in the earnings call as well. So 10 to 11% growth across revenue, EPS, and free cash flow. And with my terminal growth, discount rate, and margin of safety, that gives me an average intrinsic value with margin of safety of $205 per share and a price target for 2030 of 500 to 700 USD. Now, I think this is a very likely scenario. I would think that this is probably the most probable scenario. In this valuation as well, I haven't included the dividend income that you are projected to get. So under this base case, I think this is still a relatively very attractive opportunity to invest in. But with that being said, I also want to take you guys through the bull case scenario, because initially the company estimated EPS growth estimates from 13 to 16%. And essentially I have put together a bull case scenario where EPS and free cash flow growth continues at 18% year on year. Essentially what this does is it brings our margins at levels seen in 2023 and before, so 5 to 6% margins. And under our bull case scenario, which is less likely than our base case scenario, just because of the number of headwinds the company is facing, the price target is 700 to 900 USD. I don't think that this scenario is completely unrealistic, but with that being said, it's less realistic than the base case scenario. Now, I have also put together a bear case scenario, which essentially estimates in terms of growth of single digit growth. And essentially what this says is that margins will stay at the 3% net income basis, which is much less than the historical 5 to 6%. And under this case scenario, the average intrinsic value of the business with margin of safety is $170, which is still not that far off from the current price. But with that being said, the 2030 price target would be more close to the 300 to 500 USD per share, which wouldn't be ideal. But with that being said, even the bear case scenario, I think, would bring some sort of return, even though it would likely underperform the S&P 500. So currently the stock is trading lower at the time of recording, and the question of whether I'm buying or am I selling, I think if it dips below 260, I will definitely be adding to my position. The leadership sounds very confident and focused on the long term. They're comforting the problems directly, and I'm in for the ride. I'm not selling the stock currently. I don't think I'll sell it anytime soon. I still believe in the company. I believe it can recover. And to be fair, I'm here for the next 3 to 5 years, not the next 6 months. And in the meantime, I will enjoy a 3+% dividend yield, which may grow over time. So with that being said, I want to wrap up. I want to thank you guys for watching. Shout out to everyone who's donated. I spent a lot of time making these videos for you, spending a lot of time researching for you. So if you would like to subscribe or donate, it really goes a long way. You can find the donation link in the description. And with that being said, I'll see you all next time.